So yes, so just gone through kind of in the perfect world what actually the economic theory. So let's cover what actually happens in the messy world.
Yeah, and I'm going to go in the same order that I just did. Going back to what I said was the one that I've taken issue with about rationality is that the truth is that we're all human, and as investors we're human. Therefore, we're not at all times in all instances rational. Rapidly declining stock prices in the midst of a global health crisis are akin to a lion chasing us on the savannah the way that our brains work. Our first instinct is survival rather than profit maximization.
Yeah.
And selling stocks now and asking questions later is like climbing that first tree that you find to escape the lion and worry about getting down later. As much as we might like to think otherwise, the inner wirings of our brains really haven't evolved much beyond basic survival instinct when presented with that threat.
Oh, so true.
On the topic of market efficiency, like I said, we had fully subscribed to this notion of efficiency, but it doesn't necessarily always play out in every time increment, and the process of achieving efficiency tends to be a little bit messy sometimes. So, and I can't take credit for this analogy or metaphor, but I like to say that markets are kind of sort of most of the time efficient, but they still can't be predicted. Now, markets do immediately digest all available information. However, many different interpretations of that information make for a messy process when actually becoming incorporated into stock prices. And this process can, in the short term, cause prices to deviate from their actual value briefly and sometimes significantly. And now, despite these temporary breakdowns in perfect or true efficiency, I would love to hear from anybody who, in the slightest degree, accurately predicted the path of stock prices back in March, or how this would play out in stock prices over the course of the ensuing 3 or 4 months.
Yeah, no, it's so true. I mean, even if someone was given all the economic numbers that would have been achieved during these last 6 months, I mean, it would almost have been impossible to have the trades to profit perfectly, every time.
Right.
Because if someone told me, right, told you ahead of time at the beginning of the year in June, there's still going to be, 11, 12% unemployment, you would have thought that stocks would be down 30, 40, 50%, just with that data fact, which is in fact true today.
Right.
But that's, that just shows the how, having that information and then being able to profitably act on that information are two entirely different things.
Exactly. And I think that is a good tie into the next point, is that, like I said, stock prices are thought to track the economy, and they do, but just once that timeline becomes extended, like I said, they can't be expected to track the economy at every individual time increment. And I think
Right.
this point actually gets to the crux of the original question. Like, how can economic conditions still be so uncertain and seemingly full of risk, but even at this point, the S&P 500 for the 2020 year to date is still only down about 4%. And to help explain this, one of the lines I like to turn back to is a refrain from the book Factfulness by Hans Rosling, which explored various economic, demographic, socioeconomic trends throughout the world over the last several decades. And one of the central themes was things can still be seemingly bad, but getting better.
Yeah.
And I think that's what we've been experiencing the last few months.
Yeah. I mean, if it's okay, man, I just
Yeah.
bring up that point, like unemployment again. Just not to say that that's the one most important factor. I'm not at all, but just to bring that up. I mean, it's still 11, 12% currently, which is by historical standards,
Oh, it's terrible. I mean,
terrible. I mean,
yeah,
just terrible. I mean, it's just
11%,
terrible.
not good at
You go back to March, and almost every economist was thinking it was going to be, close to 20%. And there were several who were thinking it was going to be 25%. And there was even a handful that thought it could be closer to 30%. So I think that's kind of the point you're making. It's like, it's bad today, but it's not as bad as it had been predicted, and it's trending lower. And so it's getting better.
that 30%, that 20%, 30% scenario is off the table, more or less. At least that's the expectation now. And we see jobs start to return. And the thing with stock prices, they tend to be a little bit forward looking, looking out beyond the next 6 to 12 months. And economic data tends to be backward looking. By the
Right.
time it turns into data, it's necessarily historical information now, and that's that timing or the sequential mismatch between stock prices and economic data is, I think, is why we get a lot of these disconnects, particularly in short and stressful periods of times.
Yeah.
But the other thing is, it's important to keep in mind that the S&P 500 is most certainly not the entire stock market. Many other categories of stocks are from, even in the U.S., small cap stocks and a lot of international stocks are still down 10 to 15% on the year so far, with a fully diversified portfolio that reflects all parts of the world, all different categories of stocks on a weighted basis is down about 10% year to date at this point.
Yeah. And so that's to kind of go to the point, when people say, oh, stocks are going up. Yes, especially U.S. large company stocks are going up, and they're not that far off their high. But there's several other categories that are still, I think, more reflective of what's actually going on in the overall economy. There's a lot of sectors of the economy that are really struggling. Energy, oil companies, way down. Travel, leisure, way down. And a lot of smaller companies, as Matt said, and international companies are also farther down. So,
right. So I think the last kind of point that I wanted to make to wrap up some of these disconnects is kind of the way to think about markets and economies, rather than in a clean experiment, is that markets are a little more biological in their system as opposed to mechanical, because markets are shaped by millions of participants with individual motivations, incentives, and interpretations of data, and this really causes the path of markets to resemble something more like a gravel road with potholes, a down tree, and a river crossing, versus a nice, clean interstate highway, which is, I think, what we're likely led to believe. And both will get you to the intended destination, but just in the real world, you need a little bit more confidence in your GPS, your driving skills, and your vehicle. But even with that, you're still likely to second guess the route along the way, and even whether the destination is worth it. But we always like to remind investors that the destination is definitely worth it.
yeah, no, it's I love that analogy. It's definitely puts into perspective that economic theory. Even though in the long run it plays out and it'll be true, it's just pretty messy, and it could be pretty painful along the way to get there in terms of the trip you have to travel
Right.
to accomplish that. Yeah.